Hello, I'm Dr. Borg, and today we're going to review capital budgeting techniques. Before I did our discussion on capital budgeting, I wanted to take this opportunity to briefly discuss the concepts and some terminology regarding the time value of money. Some basic definitions. The present value is the current value of the future cash flows discounted at the appropriate discount rate. If you notice, I didn't use the word interest rate. When you're dealing with present value, because you're going backwards, going back, you're going to be using the term discount or discounted. Future value is where you're earning forward. That's where interest is earned. And at that point, you use the term interest rate. The amount of an investment, what it's worth after one or more periods. So the question I have is, would you prefer $100,000 today or $100,000 in 5 years? Well, if you're like me, it would be $100,000 today. You already would recognize that there is time value to money. So why is time such an important element in your decision? Well, time allows you the opportunity to postpone consumption and earn interest. You have simple interest, which is interest paid or earned on only the original amount, the principal, the borrowed. And you have compound interest, interest paid, earned on any previous interest earned, as well as the principal borrowed. So you could think of compound interest as that snowball going down the mountain, getting bigger and bigger each time. The simple interest formula is taking the deposit today at time zero, multiplied by the interest rate, multiplied by the number of periods. So assume you deposit $1,000 in an account that's earning 7% simple interest for 2 years. What is the accumulated interest at the end of the second year? You would take the $1,000, multiply that by the 7%, which is the simple interest, and you would multiply that by the term, in this case 2 years, and we would come up with the result of $140. So what is the future value of the deposit? The future value for this deposit is $1,140, and all we're doing is taking the initial deposit of $1,000 and adding back in the simple interest for 2 years, which would be $140. So the future value is the value at some future time of a present amount of money or a series of payments evaluated at a given interest rate. So what is the present value of the previous problem? Well, the present value is simply $1,000. It's the 1,000 you originally deposited. That is the value today. Present value is the current value of a future amount of money or a series of payments evaluated at a given interest rate. If you look at this chart, you'll see that if we have a 10% simple interest, and we're comparing that to a 7% compound and a 10% compound from the first year all the way to year 30. Well, the first year we'd assume 10-year simple and 10-year compound to be the same, but you can look at the disparities by the time you get to year 20 and 30 and so forth. The growth is going to be that significant. The future value for a single deposit, the formula is taking the deposit times 1 plus the interest rate to the number of terms, in this case, 1. So it would be 1,000 times 1.07, which equals 1,070. The compound interest, you've earned $70 interest on your $1,000 deposit over the first year. This is the same amount of interest you would earn under simple interest. However, on the second year, you earned an extra $4.90 in year 2 with compound over simple interest. We're taking the $1,000 and we're going to multiply that by 1.07 to the second power to give us the $1,144.90. The general formula is going to be deposit multiplied by 1 plus I to the nth power. There are tables that are available, present value and future value tables, found on the internet, back of textbooks and so forth. Either way works, but the math will always work on a calculator. So I wanted to go through that because the capital budgeting uses the time value of money. So why use capital budgeting? Well, capital budgeting techniques are tools used to help determine the acceptability and ranking of large investment projects. So in other words, would investing in this project cost the company money or make the company money? When you're looking at choosing a proposal, the steps that you would take would be to identify the capital investment needs, have a formal request for the capital investments, conduct a preliminary screening. Then you would evaluate the proposals based on the acceptance and rejection standards set by management. You would then rank the proposals and choose the best one. Capital investment analysis methods. We're going to talk about the net present value, the profitability index, the payback period method, and the internal rate of return. Before we do a deep dive into calculations, I want to illustrate an example which may help clarify these techniques, in addition to their advantages and limitations. So we're currently looking to renovate our kitchen, and we are interviewing and accepting 3 bids from contractors interested in this project. Now, the assumption in this example is that we would be gaining cash flows from this project, which obviously we're not. The net present value would be the first approach I would take. The technique applies the time value of money. It's commonly used, and it is the most theoretically accurate. However, you should not commit to a project solely on the basis of net present value. The first step is to determine the present value of the expected cash inflows. This is a forecasted amount. We would then add the present values of the expected cash inflows for each of the projects separately and compare this to our initial investment. If the amount of any of the bids equals or is larger than our initial investment, per the rules of NPV, we will accept the project. The higher the NPV, the more attractive the investment. If the amount of any of the bids is less than our initial investment, we reject the project. This sounds great. However, what happens if each of the projects yields a 0 or similar positive balance? Using NPV is an excellent approach to determine whether to accept or reject a project. However, it's unable to compare similar projects. For instance, in our kitchen remodel example, we only have a set dollar figure in our budget, not to mention only having one kitchen to remodel. So it is impossible and impractical to say the least to accept more than one of these proposed projects. Can only accept one. So the next approach is determining the profitability index, the PI. Take the sum of the present values on the cash flows we just calculated from determining our NPV and divide this sum into the initial investment. The higher the quotient, the greater the profitability for each dollar spent on the project. In other words, more bang for the buck. A higher PI means that a project will be considered more attractive. The profitability index, also referred to as the value investment ratio, VIR, or profit investment ratio, PIR, describes an index that represents the relationship between the costs and benefits of the proposed project. A PI greater than 1 is deemed as a good investment, with higher values corresponding to more attractive projects. Under capital constraints and mutually exclusive projects, only those with the highest PIs should be undertaken. Well, then you would consider timing. Is duration of the project a risk which should be considered? Let's go back to the kitchen example. Suppose the profitability index representing the bid of each contractor is attractive. Which of the three contractors should be selected? Well, the next approach in the ranking of the project would be the payback method. The payback method is the easiest and the oldest technique. However, it does not use the time value of money in its calculation. Think of it this way. It gets you close, using the metaphor, it gets you to the stadium, just not in your assigned seat. It's a broad or ballpark figure because we don't know the frequency of the cash inflows. Do they come in on January 1st, March 25th, October 28th? Does it come in one lump sum as equal amounts, unequal amounts, etc.? So back to the kitchen example. Would it make a difference if one contractor could complete the project in 4 months, one in 2 months, and one in 2 weeks? A project with a short payback period indicates efficiency and improves the liquidity position of a company. In addition, it means the project bears less risk, which is significant for small enterprises with restricted resources. A brief payback period mitigates risk of losses caused due to changes within the economic situation. For instance, think of all those businesses that invested in long-term projects just prior to the COVID pandemic. Again, this is the oldest capital budgeting technique with the key advantage that this approach is very easy to calculate and its ability to reduce risk. However, this approach does not take into consideration the time value of money, nor any cash flows received after the payback period. So then you have the approach known as the internal rate of return, the IRR, which is the setting, basically it's setting the NPV to 0 and calculating. This approach can be complex when dealing with sign changes in the cash flows and does not derive an annualized rate. Best to think of it this way. Suppose the capital structure of your firm yields a weighted average cost of capital, known as the WACC, W-A-C-C, and it equals 8%. This 8% represents the expected average future costs of funds from both equity and debt sources. The weighted average cost, again the WACC, comprises all of the current debt and equity the company uses to fund their projects. So, in other words, the WACC, WACC, can be considered the required rate of return. What rate the firm must earn to be able to afford its projects. You can look at this WACC, or required rate of return, of the 8% as the hurdle rate needed to be above. It's important to note, however, that the hurdle rate is a benchmark for the rate of return that is set either by the investor or the manager. And on the other hand, the weighted average cost of capital is the WACC is the cost of capital. It includes sources of all debt and equity, and the hurdle rate may be higher or lower than a firm's WACC. An IRR, internal rate of return, is typically an easy sale to convey. However, as mentioned earlier, this is not an annualized rate. Assume we had a project with an internal rate of return of 12%. This 12% is much higher than the 8% WACC, that required rate of return. Again, this is a very easy sale to go to the board members and explain that the cost of capital, the WACC, is 8% and the project returns 12%. Easy to convey, however, the 12% is not always viable. Look at it this way. A couple of years ago, when gasoline prices went down, or any commodity that was regularly used had a price decrease. Imagine if you were spending $50 a week on gasoline or this other commodity, and now your cost dropped to $35 a week. Did you, or would you, take the $15 per week, the $60 per month savings, and put the funds allocated for the gasoline or this commodity in an envelope marked gasoline, etc.? So when the price of gasoline or your consumed commodity went back up, you were covered without any risk of paying more. Well, I didn't do it either, and neither do companies. Companies typically take the proceeds from a project and allocate the funds to new ventures of interest. So it is important to note that the internal rate of return is not an annualized rate. In order to earn the 12% in our example, we would have to take all the proceeds from this project and reinvest it, allocate it right back into the project. Again, the issue is that firms take the proceeds realized from a project and invest those funds to other investment opportunities. So now let's apply these techniques. We have data, our proposed data. Tessie T is evaluating a new project for her firm's Tessie Treats. She has determined that the after-tax cash flows for the project will be $10,000, $12,000, $15,000, $10,000, and $7,000 respectively for each of the years 1 through 5. The initial cash outlay is $40,000. Well, for this project, we want to assume that it's independent of any other potential projects that Tessie Treats may have, and an independent project is a project whose acceptance or rejection does not prevent the acceptance or rejection of other projects under consideration. So let's look at the NPV for this approach. The NPV is the present value of an investment's project's net cash flows minus the project's initial cash flow. So you can see that NPV equals cash flow 1 divided by 1 plus the interest rate to the first term, first power, plus cash flow, the second cash flow divided by 1 plus the interest rate to the second term, and so forth, minus ICO, the initial cash outlay. So Tessie Treats has determined that the appropriate discount rate for this project is 13%. So the NPV in this example would be 10,000 divided by 1.13 to the first power, plus 12,000 divided by 1.13 to the second power, plus 15,000 divided by 1.13 to the third power, plus 10,000 divided by 1.13 to the fourth power, plus 7,000 divided by 1.13 to the fifth power, minus $40,000. So the NPV acceptance criteria. The management of TESI's treats has determined that the required rate is 13% for the project of this type. Should this project be accepted? And the answer is no. The NPV is negative. This means that the project is reducing shareholder wealth. Reject, as the NPV is less than 0. Let's look at another example. So you look at NPV this way. Suppose an investment costs $5,000 today and promise to pay you $7,000 2 years from today. Assume opportunity costs for projects with similar risk earn 10%. Would you make this investment? Well, to make a decision, we need to compare the $5,000 cash outflow with the $7,000 cash outflow we expect in 2 years. Using an interest rate of 10% and a term of 2. Present value of $7,000 to be received in 2 years equals $7,000 divided by 1 plus 10% or 0.10 to the second power, which equals $5,785.12. In other words, by investing $5,000 today, you are getting a return worth $5,785.12. So according to NPV, if the cash flows minus initial investment is positive, we accept this project. 5,000 minus 5,785, well, we get a positive 785.12, so we would accept this project. Suppose you are considering an investment for project X, and each requiring an investment, and project X is requiring an investment of $100,000 today. Consider the last day of 2020 and the promising cash flows at the end of each of the following years through to 2024. Should we accept this project? Well, the NPV shows that if the firms invest in Project X, they can expect to increase the value of the firm by $539.58. And all we did was we applied the time value of money to the cash flows. So the $20,000 in 2022 actually equals $16,528.93 today. 30,000 equals 22,000 today. 2024, the 90,000 equals $61,471 today. So when you take the pieces of the discounted cash flows and we subtract from our initial outlay, we're coming up with a positive NPV of $539.58. It is important to remember that a positive NPV means that the investment increases the value of the firm and that the return is more sufficient to compensate for the required return of the investment. The strengths of NPV is that besides it being, as I mentioned earlier, theoretically the most accurate, its cash flows are assumed to be reinvested at the hurdle rate. This approach accounts for the time value of money and considers all the cash flows. However, it may not include managerial options embedded in the project. Next, we have the profitability index, PI. PI is the ratio of the present value of a project's future net cash flows to the project's initial cash flow. So you could do the method 1 or method 2. If you do method 1, we're taking the cash flows for each period and dividing that by 1 plus the interest rate and the term of each period, adding those all together and dividing it by the initial cash outflow, the ICO. Or method 2, the profitability index equals 1 plus NPV divided by ICO. Either way works. So PI acceptance criterion based on the Tesi Treats example. We have we added up the discounted cash flows and they come up to $38,572, and we divide that by the initial cash outlay of $40,000, which equals 0.9643. Should this project be accepted? And the answer is no. The profitability index is less than 1. This means that the project is not profitable. Reject as the PI is less than 1. The profitability index uses some of the same information we use for the net present value, but is stated in terms of an index. If we look at the profitability index of project X, the project from before, where we have the current investment of $100,000, if we take the profitability index and we add up all of the pieces, so the discounted cash flow of $20,000 in the year 2022, what it's worth today, you add that to the discounted cash flow of $30,000 value from 2023 of today, and you add up all the pieces, well, you come up with $100,539.58. If you remember from the prior NPV slide, we had an NPV positive value of $539.58. It's the same figure, except we're adding it to the $100,000. If we divide this by the $100,000, we come up with 1.0054. As mentioned prior, if the index value is greater than 1, it means that the investment produces more in terms of benefits than costs. The decision rule for the profitability index depends on the PI relative to 1.0. So if the PI is greater than 1, it means that the investment is expected to increase shareholder wealth and we should accept the project. If the PI is less than 1.0, then this investment is expected to decrease shareholder wealth and you should reject the project. And if the PI equals 1.0, the investment expected not to change shareholders' wealth, and you could either accept or reject. Some of the strengths is that the cash flows are assumed to be reinvested at the hurdle rate. It allows comparison of different scale projects. However, it may not include managerial options, and it only provides relative profitability, and there are some potential ranking problems. The payback period. This is the period of time required for the cumulative expected cash flows from an investment project to equal the initial cash flow outflow. So in our example with Tesi's Treats, the payback period, if you look at the letters in period 3, we call that A, and we plus the difference between the initial outflow B minus C in term 3, and we then divide it by 4 period, which is D. We say, okay, 3 plus 40 minus 37 divided by 10 equals 3 plus negative 3 divided by 10, and we come up with 3.3 years. Okay, it's a cumulative inflow. So the management of Tessie's Streets has set a maximum payback method of 3.5 years for this project. Should we accept? And the answer is yes. The firm will receive back the initial cash outlay in less than 3.5 years. 3.3 years is less than 3.5 years, which was the company maximum. In other words, the payback method, think of it as how long it takes to get your money back. The payback period is also referred to as the payoff period or the capital recovery period. So, for example, if you invest $15,000 today and are promised $7,500 one year from today and $7,500 2 years from today, the payback period is 2 years. It takes 2 years to get your $1,500 investment back. Well, suppose you are considering Project X again, okay, the investment into Project X, each requiring an investment of $100,000. With this project is requiring an investment of $100,000 today. And consider the last day of 2020 and promising cash flows at the end of each of the following years through 2024. How long does it take to get your money back for your $100,000 investment? So if you look at the schedule, by the end of 2023, the full $100,000 is not paid back. However, by 2024, the cash inflow meets and exceeds the $100,000 initial investment. Therefore, the payback period for Project X is 4 years. In this example, we assume that the cash inflows are received at the end of each year, so that the payback period is always a whole number of years. However, if we assume that the cash inflows are received at regular intervals throughout the year, we arrive at a payback period in terms of years and fractions of years. For example, assume we receive regular cash inflows throughout the year. The payback period for Project X would be 3 years and 6.6 months, assuming 7,500 monthly cash inflows. So the payback approach measures the economic life of an investment in terms of its payback period. The more likely the life exceeds the payback period, the more attractive the investment. The strength is that the payback method is very easy to understand and easy to calculate. It can be used to measure liquidity, and it's easier to forecast short-term than long-term cash flows. The downside is that it does not incorporate the time value of money. It does not consider cash flows beyond the payback method, and the cutoff period is subjective. Which leaves us to the internal rate of return, the IRR. The IRR is the discount rate that equates the present value of the future net cash flows from an investment project with the project's initial cash outflow. So if we look at Tessie's Treats, the $40,000 would equal $10,000 at year 1 divided by 1 plus the IRR to the first power, plus $12,000 in year 2 divided by 1 plus the IRR for the second, and we do this for the third, the fourth, and the fifth year. We find the interest rate that causes the discount cash flows to be equal to the $40,000. Another way to look at this is to consider the investment cash flows discounted at the IRR. So the management of Tessie's Treats has determined that the hurdle rate is 13% for this project type. Should this project be accepted? And the answer is no, because when we do the math, we come up with 11.57 for each dollar invested in this project at a cost of 13%. The IRR is less than the hurdle rate. If you look at Tessie Treat's evaluation summary, the payback method says yes, accept the project. However, internal rate of return, NPV, and PI, all the approaches that use the time value of money say the project will lose money, even though it's within the time frame that's acceptable to the company. Let's go back and go to the Project X example with IRR. So looking back at the investment for Project X, we have negative 100,000, right? That's the initial cash outflow. And that's going to equal 0 divided by 1 plus the IRR to the first power plus second cash flow coming in 20,000 divided by 1 plus the IRR to the second power, then 30 plus 30,000 divided by 1 plus IRR to the third power plus 90,000 divided by 1 plus the IRR to the fourth power. Using a calculator, we get a more precise answer of 10.12 per year. Okay. The decision rule for the internal rate of return is to invest in a project if it provides a return greater than the cost of capital. The cost of capital in context of the IRR is the hurdle rate, the minimal acceptable rate for the term of return. So if your IRR is greater than the WACC, that means that the investment is expected to increase shareholder wealth and the project should be accepted. If the IRR is less than the WACC, well, then the investment is expected to decrease shareholder wealth and should be rejected. And if the IRR equals the WACC, the investment expected not to change shareholder wealth at all, and you can either accept or reject. Some of the strengths and weaknesses of IRR. The strengths is that it does account for the time value of money. It considers all cash flows, and it has less subjectivity. The major weakness is that it assumes all cash flows are reinvested at the IRR. And then you have difficulties with project rankings and dealing with multiple IRRs. Other project relationships, you have a dependent, a project whose acceptance depends on the acceptance of one or more other projects. Mutually exclusive, a project whose acceptance precludes the acceptance of one or more alternative projects. When you're looking at the scale of investment, it's a potential problem under mutual exclusivity. Scale differences are differences in the amount of the cash flow between projects. Consider a large and a small project. Where the small project has a greater IRR and a greater PI, however, the magnitude of the dollars is minuscule compared to that of the larger project. You would want to consider using the NPV based on the magnitude of the initial investment and the size of the return. Capital rationing. This occurs when there's a constraint or a budget ceiling that's placed on the total size of capital expenditures during a particular period. So assume Tessie T must determine what investment opportunities to undertake for Tessie Streets. If she is only limited to a maximum expenditure of $32,500 for this capital budgeting period, then that project of $40,000 has to be put on the shelf. It cannot be considered. Sensitivity analysis is a type of what-if uncertainty analysis in which variables or assumptions are changed from a base case in order to determine their impact on a project's measured results, such as the NPV or IRR. Single point estimates. These allow us to change from a single point, for instance, revenue, installation cost, salvage, and so forth, estimates to a what-if analysis. Utilizes a base case to compare the impact of individual variable changes. So a change in forecasted sales units to see the changes in the project's NPV. A post-completion audit. This is a formal comparison of the actual cost and benefits of a project with original estimates. It's used to help identify any project weakness. It helps develop a possible set of corrective actions, and it provides appropriate feedback, thus making better future decisions in terms of our projects. Now, I mentioned earlier multiple IRR problem. Let us assume that the following cash flow pattern for a project for 4 years, years 0 to 4, is negative 100, positive 100, positive 900, and minus 1,000. The question is, how many potential internal rate of returns could this project have? And the answer is 2. There are as many potential IRRs as there are sign changes. Well, I want to thank you for letting me present, and I want to wish everybody a good evening. Thank you. Take care.